Just imagine. You logged into your phone this morning. You poured your coffee. You sat down at the same kitchen table where you have been sitting for 32 years. You opened the app like you do every single Tuesday. And there it was. That beautiful glowing number lighting up the bottom of your screen. $416.22. Interest deposited. Earned. Yours. You smiled. Of course you smiled. You worked 41 years at the steel plant outside Youngstown, or 38 years teaching third graders in Sarasota, or you ran your own dental practice in Pasadena until your knees gave out and the insurance carrier dropped you. You finally hit retirement. You finally got that nest egg sitting in the bank. And now the bank is paying you 5% APY, high yield. They called it high yield, right there on the marketing page in bold letters, next to a stock photo of a silver-haired couple sailing a catamaran into a sunset you'll never afford. You think you won. Listen to me. You did not win. You did not beat the system. You did not outsmart inflation. You stepped on a federal landmine. You walked into the single most brutally efficient tax trap ever engineered against the American senior. And the worst part? The part that should make you absolutely furious is that the bank knew. Your bank knew. The teller knew. The brokerage knew. The Treasury Department knew. The Centers for Medicare and Medicaid Services knew. Every institution in this chain of confiscation knew that the moment they stamped that 1099-INT with your name and social security number, they were not paying you $416.22. They were dragging you, slowly, mathematically, irrevocably, over a cliff. A specific, surgical, bureaucratic cliff with a name. A name they will not say out loud on CNBC. A name your branch manager will pretend doesn't exist when you ask about a CD rate. A name that will not appear anywhere on the brochure with the sailboat. That name is IRMAA. Write it down right now. IRMAA. The Income-Related Monthly Adjustment Amount. The single most expensive acronym in your entire retirement. And you have probably never heard a single banker, broker, or branch employee mention it in your life. Why? Because it is not their problem. It is your problem. They get the deposit. You get the bill 2 years later. This is not official financial advice. It is a survival guide for a rigged banking system. Consult a fiduciary if you still trust the institutions that have spent 15 years teaching you to celebrate a 1099-INT like it's a Christmas bonus. Now let's begin the autopsy. Here is the catastrophic math. Follow along. Get a pen. You are a married couple, both 67. Both enrolled in Medicare Part B and Part D. Combined Social Security, $72,000 per year. Combined required minimum distributions from traditional IRAs, $90,000 per year, because the IRS will not allow you to leave that money alone. Pension income, $8,000. Qualified dividends from a small taxable brokerage account, $3,000. And $100,000 sitting in a high-yield savings account earning 5%. Let's add it up the way the IRS adds it up. Social Security, 85% of that is taxable at your income level, so $61,200 flows into adjusted gross income. RMDs, $90,000, fully taxable as ordinary income. Pension, $8,000, fully taxable. Qualified dividends, $3,000, still counted in AGI. And the HYSA interest, $5,000, ordinary income, 100% taxable. Total, $167,200 of adjusted gross income. Add back a few items the bureaucracy specifies, and you arrive at your modified adjusted gross income, MAGI, the single most weaponized acronym in senior finance. In this scenario, your MAGI lands at approximately $209,000. Why does that matter? Because in 2026, the IRMAA brackets for a married couple filing jointly start triggering surcharges right around the $212,000 threshold for the first tier. Without that $5,000 of free money from the bank, your MAGI would have been $204,000. Below the danger band. Standard Medicare premiums for both spouses. No surcharge. No penalty. Clean, done, move on. Instead, you cross the line by $5,000 because of the bank. Here is the invisible tax. In 2026, the standard Medicare Part B premium is approximately $210 per month per beneficiary. Two of you. $420 per month, $5,040 per year. That's your baseline. But you crossed the IRMAA threshold. So the Tier 1 surcharge stacks on top. Approximately $74 per month per beneficiary. Two beneficiaries, $148 per month. Times 12, $1,776 per year in additional Part B premiums alone. Then the Tier 1 IRMAA surcharge for Part D adds approximately $13.70 per month per beneficiary. Two beneficiaries, $27.40 per month. Times 12, $328.80 per year. Total IRMAA penalty for crossing the cliff by less than $5,000. Approximately $2,104 in extra Medicare premiums for 1 calendar year. Now we layer the federal income tax on the same $5,000 of interest. Your marginal bracket at this income level in 2026 is 24%. 5,000 times 24%, $1,200 in federal income tax on the interest itself. State income tax. If you live in Ohio, roughly 3.5%. $175. California, 9.3%, $465. Florida, 0. Total damage for an Ohio couple, $1,200 federal plus $175 state, plus $2,104 IRMAA surcharge equals $3,479. You netted $1,521 on a $100,000 deposit. That is a real yield of 1.52%, not 5, 1.5. The bank advertised 5. The IRS and CMS quietly reclaimed nearly 70% of it. For the California couple, $1,200 federal plus $465 state plus $2,104 IRMAA equals $3,769 in confiscation. Net, $1,231. Real yield, 1.23%. Inflation in 2026 is running at 3.1%. You lost purchasing power on a high-yield account while playing it safe. Read that again. The penalty will exceed the interest. You paid more in extra taxes and Medicare surcharges than the bank ever paid you. You loaned the bank your money so they could lend it out at 9% on credit cards. They paid you 5%. And the federal government took back nearly 4% through mechanisms that don't even appear on your tax return as a line item. You lost money trying to play it safe. That is the entire premise of this video. Now let me explain why bank interest is the most aggressively taxed money in America. Because there are categories of income in the United States tax code, and not all dollars are created equal. Category 1. Ordinary income. Wages, salary, pension, RMDs from traditional IRAs, short-term capital gains, non-qualified dividends, and yes, bank interest. Bank interest sitting right there in the worst category, taxed at your full marginal bracket. No preferential treatment, no deferral, no shelter, no mercy. Category 2. Qualified dividends and long-term capital gains. Taxed at preferential rates of 0%, 15%, or 20%. For most retirees in the middle income band, this is 15%, significantly less than ordinary income. Category 3. Tax-exempt municipal bond interest. Federal income tax 0. State income tax 0 if you buy bonds issued by your own state. Does count toward MAGI for IRMAA purposes in some calculations, but the federal income tax line stays clean. Category 4. Roth IRA distributions. Tax-free at every level, federal, state, local. Does not count toward provisional income for Social Security taxation. Does not count toward MAGI for IRMAA the way taxable distributions do. The cleanest dollar in American retirement finance. Now look at where bank interest sits. Category 1. The worst category. The maximum extraction point. And what does the bank advertise? High yield. They advertise the gross number, never the net. They have no obligation to tell you what category the interest falls into, what your effective net yield will be after taxes and IRMAA surcharges, or what the chain reaction looks like through your Medicare premiums 2 years from now. The tax consequences are, in the elegant legal phrasing used in the marketing fine print, the responsibility of the depositor. That is you. That has always been you. Here is the mechanical chain. Memorize it. Step 1. Bank pays interest. Step 2. 1099-INT is generated and filed with the IRS. Step 3. The interest hits line 2B of your Form 1040 as taxable interest. Step 4. It flows into your AGI. Step 5. AGI plus certain addbacks equals your MAGI for IRMAA purposes. Step 6. That MAGI is reported by the IRS to the Social Security Administration. Step 7. 2 full calendar years later, the SSA uses that MAGI to set your Medicare Part B and Part D premiums for the entire upcoming year. Step 8. If your MAGI crossed a tier, you get a notice in late autumn announcing your new premium for the following January. Step 9. You call the SSA. They tell you the determination is final unless you can demonstrate a qualifying life-changing event, which earning extra interest does not qualify as. Step 10. You pay the surcharge for 12 consecutive months with no monthly recalculation. You crossed by $1. You pay the full tier surcharge for the entire year. That is the 2-year look-back. That is the trap. The interest you earn in 2026 will not show up as an IRMAA surcharge until your 2028 Medicare premiums are calculated in late 2027. You will have completely forgotten about that bank account by then. You will be eating dinner in October 2027 when a letter arrives from CMS informing you that your Part B premium just jumped by $74 per month for all of 2028. And you will have no idea why, because no one in the chain of custody ever connected the dots for you in advance. This is by design. Here is the cliff structure in full. IRMAA is not a slope, it is a cliff. $1 over the threshold and you fall off the edge. $2 over, $5,000 over. Same surcharge, same tier. The penalty is identical whether you crossed by a single dollar or by 10,000. There is no proportionality. There is the threshold, and you are above it or below it. 2026 IRMAA tiers for married filing jointly. Tier 0. Magi up to approximately $212,000. Standard premium, no surcharge. Tier 1. $212,000 to $266,000. Part B surcharge approximately $74 per month per beneficiary. Part D approximately $13.70 per month. Tier 2, $266,000 to $334,000. Part B approximately $185 per month. Part D approximately $35 per month. Tier 3, $334,000 to $400,000. Part B approximately $295 per month. Tier 4, $400,000 to $750,000. Part B approximately $460 per month. Tier 5, above $750,000. Part B approximately $443 per month per beneficiary. A married couple at the top tier pays roughly $12,600 per year per couple in IRMAA surcharges alone, on top of the standard premium, every year, indefinitely, as long as their MAGI stays in that band. And here is the part the banks will never tell you. The cliffs are not indexed smoothly. The thresholds adjust slowly, while bracket creep eats your income aggressively. Every year your traditional IRA balance grows, the RMD gets larger. Every Social Security cost of living adjustment makes the 85% taxable portion larger. Every year, the bank holds your $100,000 in HYSA, the interest compounds. And every year, More middle-income retirees who thought they were nowhere near the rich person IRMAA tier wake up to discover they crossed the line and never saw it coming. This is not a problem for the truly wealthy. The truly wealthy have already structured their assets to never generate ordinary income in the first place. This is the tax that disproportionately punishes the upper-middle-class American retiree, the teacher with a pension, the engineer with a 401k, the small business owner who diligently saved, the exact person who least expects to be in the line of fire. Now let's talk about what you actually do starting Monday morning. Furious is not enough. Let's dismantle the trap. Strategy 1. Municipal bonds, specifically issued by your own state. Federal income tax, 0. State income tax, 0. The interest appears on line 2A of your 1040 as tax-exempt, not line 2B as taxable. It does still get added back into MAGI for IRMAA purposes. So munis are not a complete solution, but they eliminate the federal income tax leg entirely. For the Ohio couple, swapping the HYSA for Ohio General Obligation Bonds at 3.5% tax-exempt saves the $1,200 federal and $175 state portions. Partial fix, better than the bank, not a complete defense. Strategy 2. Roth conversions executed strategically in low-income years before RMDs begin. The window is narrow. It opens the day you retire and slams shut when RMDs start at age 73. In that window, every dollar you convert from traditional IRA to Roth pays the tax now at known rates and removes the future RMD burden forever. You pay at 12% or 22% in your 60s and eliminate the RMD that would have sat in the 24% or 32% bracket while triggering IRMAA. The arithmetic of strategic Roth conversion versus passive RMD acceptance is, in many cases, the difference between a comfortable retirement and a 30-year IRMAA tax sentence. Strategy 3. Properly structured cash value life insurance, specifically designed for tax-free retirement income access through policy loans. Not the kind your uncle bought from a guy at the country club in 1987. A specifically engineered, max-funded, low-commission, high cash value design used as a non-MAGI distribution vehicle. The premiums fund the cash value. The cash value grows tax-deferred. When you need income, you borrow against it at a net zero or near-zero loan rate. The borrowed funds are not income. They do not appear on your tax return. They do not flow into AGI or MAGI. They do not impact IRMAA. Done wrong, it's a disaster. Done right, it is one of the few legitimate non-MAGI income sources available to the middle-class American retiree. Strategy 4. Health savings accounts. If you're still in a high-deductible plan before Medicare enrollment, HSAs are the single most tax-advantaged account in the entire code. Contributions are deductible. Growth is tax-deferred. Qualified medical withdrawals are tax-free. After age 65, non-medical withdrawals are taxed only as ordinary income, exactly like a traditional IRA. But used for medical expenses, they remain completely tax-free forever. Most retirees are spending current dollars on medical costs and ignoring the HSA entirely. Reverse it. Pay medical out of pocket if you can. Save the receipts. Let the HSA grow. Withdraw tax-free in retirement when you need clean, non-MAGI income. Strategy 5. Treasury bills held to maturity. Federal interest is still taxable as ordinary income, so this doesn't solve the federal layer. But Treasury obligations are exempt from state income tax in every single state. For a California resident, swapping the HYSA for a 6-month T-bill ladder eliminates the $465 state tax bill entirely. Combined with munis, a mix of in-state bonds and Treasury bills can dramatically reduce total tax drag on your fixed income allocation. Strategy 6. Qualified charitable distributions, the QCD. Available to anyone 70 and a half or older. You can direct up to $18,000 per year directly from your traditional IRA to a qualified charity. The distribution counts toward your RMD. It does not show up as taxable income. It does not flow into AGI or MAGI. It does not impact IRMAA. If you are charitably inclined, the QCD is the single most efficient charitable giving vehicle available to American seniors, and it doubles as an IRMAA management tool. Most retirees have never been told this exists. The high-yield savings account is not the safe harbor the marketing promises. It is the most aggressively taxed dollar in your entire portfolio, dressed up in advertising designed to look like a gift. The 5% yield is real. The 1.5% net yield after the three-layer extraction, federal income tax, state income tax, and the 2-year look-back IRMAA surcharge is also real. The bank earns the spread. The IRS takes the federal cut. Your state takes its bite. CMS takes the rest through Medicare premium surcharges. You will not see until 2 calendar years after the damage is done. By the time the bill arrives, the interest is long spent. The deposit decision is long forgotten. And the only thing left is the surcharge eating into the retirement income you thought you were protecting. Stop feeding the bank and the IRS in tandem. Stop celebrating an interest deposit that is mathematically reducing your purchasing power. Move the cash to a treasury ladder. Build a municipal bond allocation. Execute Roth conversions in the years before RMDs begin. Set up QCDs the moment you turn 70 and a half. Restructure now, before the next quarterly statement. The next time you log into your bank app and see that little $400 interest deposit lighting up your screen, remember what you just learned. That is not a gift. That is a confession. That is the bank handing the IRS a signed declaration in your name. That is the first domino in a 2-year chain reaction that ends with a Medicare premium surcharge you cannot appeal. You worked 40 years. You paid into the system your whole life. You earned the right to keep your money. Stop using high-yield savings as your default cash position. I'll see you in the next one. Let me explain the income category structure one more time, because this is the foundation of everything. The banks have a structural incentive to make sure you never learn it. There are 6 categories of income in the United States Tax Code. Category 1, ordinary income. Wages, pension, RMDs, bank interest, short-term capital gains. The worst bucket, maximum taxation. Category 2, qualified dividends and long-term capital gains. Taxed at 0%, 15%, or 20%. Far more favorable. Category 3, tax-exempt municipal bond interest. 0 federal income tax, 0 state if in-state bonds. Category 4, Roth IRA distributions. Tax-free at every level, federal, state, local. Does not count toward provisional income for Social Security. Does not inflate MAGI for IRMAA. The cleanest dollar in American retirement. Category 5, return of basis. Dollars you already paid tax on, tax-free when withdrawn. Category 6, cash value policy loans from a properly structured permanent life insurance contract. Treated as a loan, not income. No 1099. No reporting. No bracket impact. No IRMAA. Bank interest sits in Category 1, the worst category, the maximum extraction point. And what does the bank advertise? High yield. The gross number, never the net. They have 0 obligation to walk you through the IRMAA chain reaction. Here is what I want you to do before you make another deposit decision. 1. Look at your current MAGI. Use last year's tax return as a baseline. Add or subtract known changes. New RMDs starting, Social Security increases, any planned asset sales. Know your number and know how far you are from the next IRMAA cliff. Print the 2026 threshold table and keep it somewhere visible. 2. Calculate the real net yield on every interest-bearing account you currently hold. Federal rate times the interest amount. State rate times the interest amount. Then estimate the IRMAA exposure if the interest pushes you over a tier. The real yield is almost certainly not what the marketing page says. 3. Have a conversation with a fee-only fiduciary who understands IRMAA and Roth conversion modeling before you renew any CD or move any additional cash into a high-yield account. 1 hour with the right professional, one time, is worth more than every bank interest deposit you will earn in the next 5 years combined. Comment below with the rate your bank is paying you and your filing status, married or single. Drop the number. I read the comments, I respond, and I want to see exactly how much of this audience is sitting on a ticking IRMAA grenade without knowing it. Your field report becomes the ammunition for the next video. Share this with one retiree you care about today. Not tomorrow, today. One conversation now saves them $15,000 in cumulative Medicare surcharges over the rest of their retirement. You will be the only person in their life who told them the truth before the letter arrived. Subscribe if you haven't. Hit the bell. The follow-up video walks through the precise reallocation sequence with sample portfolios for 3 income brackets. Like this video to break through the suppression. And save it because this is your survival manual. The next time you see that interest deposit lighting up your screen, remember, that is not a gift. That is a confession.